From California, Mr. Sherman is recognized.
Thank the subcommittee for allowing me to participate. As I think the gentlewoman from Texas pointed out, we have an enormous trade deficit with China because we granted them most favored nation status. We therefore have a trade deficit of over $1/3 trillion every year. That means they have built up every decade $3 trillion that they can spend or invest. The idea that we can prevent them from being able to fund this $20 million project or this $60 million project is kind of silly. If Americans can't invest in a particular company on the Shanghai Exchange, its price may drop a little bit. Chinese investors will see that that's a buying opportunity and the stock will go back up. But while we can't prevent China from funding $20 million here, $50 million there, we can discourage the export of American technology. And it's one thing to say, oh, here's a fully drafted plan and somebody's going to sell it for $40 million and we're going to prevent the export of that technology. But often technology is know-how. It's a connection. It's an idea. And when an American company has an incentive to provide that to a Chinese partner, it will be provided. The best example of this was we had American companies contract with China to put their satellites in orbit. So what did our companies do? They told the Chinese how to do a better job with their rockets. And so did our insurance companies who were insuring those launches. So we want to discourage joint ventures, major venture capital investments by people in the United States who have ideas and have knowledge and contacts that they could pass on. Now, while we can't starve China for investment capital, we don't need to incentivize it. We have a capital gains allowance in our tax system. The thinking is that we should forego tens, maybe hundreds of billions of dollars of tax revenue to encourage people to buy stock which builds the economy. Well, when they buy stock in a Chinese company, they're building the economy of China. Ms. Kelsey, can you think of a reason why we should provide very enormous tax incentives for people to invest in Chinese companies?
I can't, sir. That does sound interesting.
Does any of our other witnesses think it's a good idea to provide the capital gains allowance and the step up in basis upon death as investment incentives when you're investing in Chinese companies? One word answer? I see one witness, I think both of you are shaking your heads no? Yes, well, for the record. We've got one oral no and two nonverbal no's. Now, you know, if it was my preference, we wouldn't have American capital flowing to China at all, except we have a certain vulnerability because we have this huge trade deficit. They've got a lot of money, and we need them to invest it in the United States. And while stock investments and equity investments are roughly equal, going in both directions, they have more than $1 trillion more of debt capital that they provide the United States. Now, debt capital isn't as valuable to our economy as equity capital, but it's $1 trillion. So it's very hard to say we're going to stop, we're going to cut the flow of capital in one direction. But I will point out, as that capital gains allowance, China has investment incentives for its own people to invest in Chinese stocks. They don't provide those incentives to invest in the United States stocks. So there's certain fairness there. And finally, I'll point out as to the trade deficit, we have tariffs on China, their tariffs on our goods higher, and they can orally instruct their companies not to buy American goods. And we can't prove it, we can't know about it, they just don't buy. And that's why we have a huge trade deficit. That's why we need much higher tariffs on Chinese goods to make up for their non-tariff and non-disclosed barriers. And I look forward to working with my colleagues on all these matters. I yield back.